figure of negative 3935 is the NCI that's attributable to the total comprehensive income that's attributable to the NCI. Okay, let me have a look at the time. I suspect it's about 2:30, and it is 2:30. Group profit and loss accounts and OCI. We will see you again on revision. So in terms of P&Ls and OCI, I am saying au revoir. I'm saying auf Wiedersehen. I'm saying until we meet again. We shall be looking at a P&L again. We'll be looking at that again on the revision phase. Yeah? Just in case it comes up. Obviously the main strike on the revision is going to be about the balance sheet. And because that's the thing that comes up most of the time. Right. I've got one major story left in me this afternoon, and that major story is a little bit of a hit or miss. Because I have to be honest with you, this topic doesn't normally come up. But if it does come up, it's a 35-mark compulsory number crunching question. It featured very briefly in the last exam, in question 4. Very clever, apparently, of the examiner to integrate a little bit of it in. But traditionally, I'm talking cash flow. I'm talking cash flow. 5 times out of 7, 4 times out of 6. It's a balance sheet question at question number 1. But he does throw in a surprise every so often. Because sometimes it's a P&L, and sometimes it's a cash flow. I cannot send you into battle naked. I cannot send you into battle unprepared. You need to be able to do a cash flow question. Because if it comes up, it's compulsory. If it comes up, it's 35 marks. If it comes up, there is no hiding place. This is my story. This is my journey on cash flow. It's going to start fairly slowly. It's going to start at F7. I'm going to tell you about the format of the cash flow. I'm going to recap how we do the calculations of the cash flow. This is going to take half an hour, and some of you may fall asleep. Because it's going to be so easy and so straightforward. But some of you might be thinking, oh yeah, okay, this is what I do need to know. I need to know the basics. When we're all up to speed with our basic format and our recap of knowledge, when we're all up to speed, we can then learn 4 new things. Please don't get too excited. These new things are very small. Once you've got the rhythm, once you've got the feel of a cash flow, the extra things that happen at P2 are not major. What does happen at P2 is just the questions are stupidly big, all right? And they start involving all sorts of weird stuff, all right? So we need to do a question so that you're not just looking at the small isolated and the small isolated and feel that you're in control, because part of it is about getting lost in a big question. So I'm going to start with looking at the format of the cash flow statement. Now, before I start, I'm not going to write out the format. I'm just going to be a very bit loose here. The format of the cash flow is beautifully set out in your notes. And if you just want to have a look at the format of that cash flow, It's all there, and it's all there on page 191, you know. There it is, and there's a need for you to rote learn the format. Seriously. When we do a group P&L, in the question itself, there are 3 P&Ls that you're just copying out. When you're doing a group balance sheet, there are 3 balance sheets in front of you which you're just cross-casting. When you do a cash flow, there's no cash flow. You have to remember the format of the cash flow. So I hope this is revision. How many headings are there? 3. Operating, investing, and finance. I'm not copying the whole thing out. I'm just playing some games. Now, the method that gets examined is known as the indirect method. So if we're looking at the indirect method, what do we start with? What's the first number that I write down here? Profit before tax. Time out for a second. I think that's stupid. What are we preparing? A cash flow statement. Well, profit isn't cash. So it's called the indirect method because you're not starting directly with the cash. You're starting with profit. So the first thing that I need to do is to reconcile that profit to the cash that we have actually generated. So the first thing I'm going to do is to think of expenses. Expenses which have reduced profit down, but I haven't paid any money. If I have an expense that reduces profit down, but I haven't paid any money out, I will look to add it back here straight away. What sort of expenses are we thinking about? Depreciation. So we would add back depreciation. We would add depreciation, your tangibles, amortization on your intangibles, impairment loss on your goodwill, all the same thing. So we'd add back depreciation, amortization, impairment losses, any losses. Losses on disposal are not cash flow. Foreign exchange losses are not cash flow. We'd add back our finance costs. We'd add back our increases in provisions. We'd add back our current service costs, our past service costs, our settlements and curtailments. We'd add back our share-based payments. We'd add back anything that was a non-cash expense that has dragged profit down but no money has gone out. Depreciation, impairment, amortization, loss on disposal, foreign exchange loss, increases in provisions, current service costs, past service costs, settlement, curtailment, share-based payments. Oh my God, it's a simple idea. Add back the non-cash expense. Finance costs would be my first one. Yeah, depreciation would be my second one. Those are the obvious ones that you always have. Add back your non-cash expenses. And then you do the opposite for your income. So if you've got investment income, profits on disposals. Yeah? If you've got investment income, income from associates, profit on disposals, government grants. If you've got any income, then you would do the reverse. So you would deduct your non-cash income. So anything that's in the P&L gets reversed out. And then you deal with your changes in working capital. Bless you. So inventory and receivable. If stock goes up, cash goes down. If debtors go up, cash goes down. If creditors go up, that's good for cash flow. So you deal with your reconciliations. So you actually start your cash flow with a thumping great big reconciliation. That's the beginning of the cash flow statement. My language is now going to be crisp. My language is now going to be very precise, because I am now in a cash flow statement. So it is either in or out. It is either received or paid. It is very black, it is very white. It is very positive or very negative. There is no middle ground here. And in my operating activities, I have 3 cash flows, and they are all out. I have my interest that I have paid. I have my tax that I have paid. And I have my pension contribution that I have paid. My pension contribution that I have paid. And these are all payments. These are all cash flows going out. I went back to the UK in the summer, and going back to the UK is a bit of a shock, really, because you go back in the summer and you think I think the summer is warm in the UK, but having been out here, I go back to the summer in the UK and it feels cold. Terrible. And the food's rubbish. Food's terrible in the UK. Anyway, it's home, so it's nice to go back. But I tell you what, when I went back, it was very expensive. When I went back, one of my kids had just left university, he'd overspent. So I had to give him some money to clear some of his debts. So I spent some money clearing debts. We went on holiday. So we went to Italy, and then that's quite expensive because you have to get on the aeroplane and go in a villa and everything like that. So I spent money on a holiday, and the car needed replacing, so I had to end up buying a new car. Not that I get to drive it much. So I spent money paying off debts, going on holiday, and buying a car. Which of those is investing? Which of those is investing? Do you invest in a holiday? Do you invest in paying off debts? No. So what do you invest in? Buying a car. Anything to do with non-current assets. This is anything to do with non-current assets. Anything to do with non-current assets. So what are we doing? We buy, so money goes out. We sell, so money comes in. Or there is a return, so money comes in. It's called investing activities because you're investing in the business. Buying plant, buying investments, buying joint ventures, buying brands, buying intangible assets, money out, money out, money out, money out. Buying things which are non-current assets or sale proceeds on disposal. So there's a little bit of money that comes back in on the disposal. If you've got an investment property, there'll be rental income. If you've got an investment, there'll be dividends received. So if you've got a return on your investment, that's also investing activities. So what do you call the money when you pay off debt? Financing, yeah. F9. There are 2 ways to finance a business. Debt and equity. So everything to do with financing activities, is to do with debt or is to do with equity. Everything to do with financing activities is to do with debt or is to do with equity. And if it is to do with debt, then you either borrow or you repay. If you borrow, money comes in. Loans go up, money comes in. If you repay, money goes out. You're repaying your debts, finance leases included. If it is equity, then it is about the proceeds of a new issue. Hang on a minute. Shareholders give us money when we give them a share certificate. They give us money. What do we call it when we give them money? Dividends. Yeah, dividends. So dividends paid is money going out. Honestly, the examiner will play a trick on you. In a 35-mark question, there'll be something weird. In a 35-mark question, there may be something that you've never come across before, that is not in the pro forma, but I'll tell you what, if you come across something that you're not sure about, you've only got to ask yourself 2 questions. 1, direction. Is it a receipt or is it a payment? Yeah, that's not going to be a difficult question to answer. And secondly, which of the 3 headings should it go under? Operating, day-to-day, or is it to do with non-current assets, or is it to do with debt and equity? So if you come across something that you are not sure about, you just stop and you say, yeah, it may be a non-cash item in profit. Well, you know to add back the expense or whatever. It may be a non-cash item. You just say, okay, is it a receipt or is it a payment? Yeah, and is it to do with operating, investing, or finance? And you make a decision within 30 seconds. You make a decision within a minute, and you get on with it. And if you happen to be wrong, you happen to be wrong. But I would have thought the chances are you will be right. Learn the pro forma. Yeah, you can do that on your own. Copying out a few times will mean that you rote learn it. But what I just want to do here for 5 minutes is just ask you to understand it. Yeah, reflect on it. And all this then reconciles to your cash and cash equivalents. Yeah, readily disposable into known amounts of cash. Yeah, without risk of changes. Cash and cash equivalents, no risk of changes, so not equity investments, and less than 3 months. Yeah, so you reconcile to your cash and cash equivalents. Right, 1 test and 1 test only. 1 test and 1 test only.